afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We come to you live throughout the day from the 85th Annual STA Market Structure Conference in Washington, D.C. Joining me for this segment is Joe Wald. He's the Chief Operating Officer of the Clearpool Group. Joe, it's great to have you on set with me today. Let's talk about the tick size pilot, super hot topic here at STA this year. It's been met with less than favorable feedback. What do you think some of the drawbacks may have been?
Well, personally, I don't view it as a failure at all. I think that the tick size pilot actually, to me, is a harbinger of things to come. And I think there were tremendous lessons learned from the tick size pilot, really specifically around how market structure changes impact shifts in liquidity and how incentives, in many cases, drive those shifts. And I think ultimately what it demonstrated is that the search for best execution has to be one that is active. It can't be one that's passive. It has to be something that you do something about. And I think a big issue, and maybe one of the reasons that people are calling the tick size pilot a failure, is because a lot of people did not take the necessary steps to tune their strategies to be able to change with the way the market structure shifted and the way that liquidity had shifted in the process of the pilot.
So then what could have been done to make the pilot more successful?
Well, I think, the pilot in and of itself had certain goals that I think may have been a bit unrealistic. But if you're looking at the pilot from a market structure perspective, I think it actually did accomplish a lot of the goals that were intended. And that is basically how do shifts of liquidity, how do changes in market structure interact to be able to help clients achieve best execution. I think one of the best examples of this is when you looked at all three of the groups, the group that had the trade at had more volume shift to exchanges. The groups that had different changes to them had, maker-taker venues go away and inverted venues come back in line. So there were a lot of things that happened. And I think one of the biggest failures of the tick size pilot were people who did not tune their algorithms to adapt properly. I think based on some of the research that we've done, if you were there waiting for the rebate in those tick size pilot names where you were just sitting there trying to get passive liquidity, because volume had shifted, you were waiting there for a very long time. And in many cases, then you'd have to cross the spread to execute at a higher price at an inopportune time. I think that kind of complacency is one of the biggest lessons that I think we can take out of the tick size pilot and really move into the access fee pilot. And I think one of the things to make that such a success is going to be really to monitor the changes in behavior and the way that people are executing their strategies. Because if they don't do anything, nothing's going to happen. You're not going to get anything different. And I think that's kind of what happened. And the tick size pilot fell victim to a lot of inaction that could have really resulted in some meaningful execution quality opportunities for people who actually leveraged it the right way.
Well, let's talk about best execution. It's always a hot topic when it comes to market structure, whether it's STA or just day-to-day with what you do. Can you give us some insight into the venue analytics report by Greenwich Associates that Clearpool had commissioned? Tell us a little bit about that.
Sure. Well, venue analytics has become a critical part of being able to analyze where you're routing your orders. It's all about the routing protocol that your algorithm takes. And it's not just about where you go, but where you get executed. So you've got people looking at, hey, we've got a fill here, but they're not looking at the route that order took to get that fill. And in many cases, much of the information leakage and much of the slippage occurs because routing protocols are sloppy, or because they favor their own pool, or they favor certain pools that they may be invested in. And I think it's critical to look at it from a venue analytics perspective. What we've done that I think is so unique is because Clearpool has such a large data set. Today we execute over 2.5% of the U.S. ADV on behalf of our broker-dealer clients. That through that aggregated, anonymized data set, we have a great view into which venues are performing optimally and, more importantly, when. So there's no such thing, I believe, as a good venue or a bad venue. But there are optimal times to use one. There are optimal order types to use. I think a great example is kind of some of the research that we've done and some of the outreach that we've done with respect to Nasdaq's mellow order type. It's a great example of midpoint liquidity that's differentiated because of the way that market has structured the way that order type works. And our venue analysis lets you go ahead and compare apples to apples. Show me all the midpoint order types that I've used. Show me how they all perform. And if one stands out versus the others, you can make a decision about adding that to your routing protocol while taking out the others. And I think that's a great example of how venue analytics has really evolved It's something that's kind of been around for a while,
Right.
but looking at it, from a peer analysis standpoint, where you've got the ability to look at not only your own flow, but a group of others to compare that with. Being able to look at it on an order type level, where it's not just good venue, bad venue, but being able to drill down into the specific order types that you use to distill how to use that venue best, and then being able to look at that in a visual way.
Right.
So you're not looking through reams of spreadsheets, but what you're looking at is pie charts, bar charts, things that traders are familiar with, people that look at this every single day can intuitively understand, oh wait, there's something happening over here. I don't have to calculate the reversion. I can see it on a chart and understand that maybe this isn't the optimal venue for me. Maybe I should be using a larger minimum execution quantity.
Right.
All of those facets are what make using a routing protocol more effective, and that's what venue analysis completely highlights for our users. It really shows them how to then take our tools and then configure their strategies, whether they're Clearpool users or not. We think the venue analytics tool is a huge benefit to all market participants that are searching for best execution.
All right. Well, thank you so much, Joe, for joining us at STA. And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets